Hey there, accounting students! Today I'm going to help you master investment property accounting under IFRS. So buckle up and let's dive right in. First off, what is an investment property? According to IFRS, investment property is real estate held to earn rentals or for capital appreciation, or both, rather than for use in the production or supply of goods or services, or for administrative purposes, or sale in the ordinary course of business. In simpler terms, if you're holding a property to earn some rental income or to sell it at a higher value in the future, that's your investment property. Now let's talk about the two main accounting methods for investment property under IFRS, the cost model and the fair value model. Under the cost model, investment property is carried at its cost less any accumulated depreciation and any accumulated impairment losses. Think of it like owning a car and recording its purchase price, then deducting depreciation over time. This method is straightforward and works well for properties where market values are not readily available. On the other hand, the fair value model requires that investment property be measured at fair value at each reporting date, with changes in fair value recognized in profit or loss. This means if the market value of your property increases, you record a gain. If it decreases, you record a loss. The fair value model provides more relevant information for decision-making as it reflects current market conditions. So, which method should you use? That depends on a few factors. The fair value model is often preferred because it aligns with the principle of providing relevant information to users of financial statements. However, if determining fair value is impractical, or if the market is not active, the cost model might be more appropriate. Let's look at an example to make this clearer. Suppose you have an investment property that you bought for $500,000. Under the cost model, you would record the property at this cost less any depreciation. Let's say after a year the accumulated depreciation is $10,000. The carrying amount would then be $490,000. Now, using the fair value model, if the fair value at the end of the year is $520,000, you would recognize a gain of $20,000 in your profit or loss. However, if the fair value drops to $480,000, you would recognize a loss of $20,000. It's crucial to note that once you choose a model, you must apply it consistently. Switching between models is not allowed unless there's a change in how you use the property. And even then, it's subject to specific conditions. In summary, investment property accounting under IFRS involves deciding between the cost model and the fair value model. Each has its pros and cons, and the best choice depends on your specific circumstances. All right, that wraps up our discussion on mastering investment property accounting under IFRS. Remember, understanding these concepts is vital for your journey as a future accountant. Keep practicing, and you'll get the hang of it in no time. Thanks for watching, and happy studying.